Alright, welcome to part 5 of chapter 19. Now we are going to apply this example. Okay, this is an example of a lockbox system which is not available in Malaysia, but it's an interesting system to look at how it can reduce the float, and also accelerate collection. This is one means of reducing your collection delay. Right, it says that you can reduce your collection delay by adopting this lockbox system by 2 days on average. An average number of daily payments to each lockbox. Remember, there are 3 lockboxes here, so each lockbox has 5,000 checks, and the average size of payment is $500 per check. Now the processing fee is given as 10 cents per check plus $10 to wire the funds. Wire here means transfer the funds through electronically to a centralized bank at the end of each day. So these are the information given. So you need to compute whether whether this system is worth the cost. So basically what we need to do is look at the benefits from the system. Remember, the NPV analysis is simply the present value of benefits minus the present value of the costs. Therefore, let's look at the benefits first, and then we look at the cost. What are the benefits? The average daily collections will be 3 number of lockboxes, and each lockbox will have 5,000 checks receiving. It will receive 5,000 checks every day, and each check will be worth $500. So this will be just the average daily receipt. This is similar to the average daily receipt, or ADR, that we have seen in the formula. So this will account for 7.5 million average daily collection. Now the increased bank balance, this is the savings that you will get, because you save 2 days, number of days saved will be 2 days, multiplied by this, 7.5 million. So it's 15 million. This is the average daily float, reduced average daily float or savings. This would be your benefit. And this this 2 here is actually the reduced weighted average delay. This is WAD, and this is ADF, if you like. This ADF is the savings, the present value of the benefits. Okay, now we come to the cost. So this is the benefit, this is the present value of benefits, 15 million. We assume that this 15 million is obtained at time 0, now. And then the costs here, these are daily costs, 10 cents for every check. Remember, there are 3 number of lockboxes and 5,000 checks per lockbox. Therefore, this will be the total amount of processing that the bank will charge you per day, plus $10 from every lockbox to transfer the funds at the end of the day to a central fund. So $10 for each lockbox. Therefore, there are 3 lockboxes, so this is $30. So it's $1,530. The total here is $1,530. This will be a daily cost. This cost is daily. Remember, this is one-off, and you get it now. This 15 million is what you get now, but the cost is $1,500 only. But this is a daily cost. So we need to compare kind with kind. You cannot compare benefits with costs when they are in different measures. This is 15 million now, but this is $1,530 daily forever. Because we assume that this will be a cost forever, every day. Okay, so which is better? We don't know, so we have to take the present value of this. Then only we can compare the two. So the present value of daily cost, we assume this is a perpetuity. So we divide this by the daily interest rate. Remember, this is a daily payment. Therefore, we need the daily interest rate. We discount this at the daily interest rate. Remember the perpetuity formula? Perpetuity value, it's just the perpetual payment divided by the interest rate. Therefore, it is 1530 divided by 0.0001. Remember, the interest rate, daily interest rate is 0.01%. Therefore, if you change this to decimal, it works out to be this. So if you divide, it is 15.3 million. This is the present value of the cost. Yeah? That means you pay $1,530 every day forever. Yeah? The value of this, the cost of this, the present value of this cost will be 15.3 million now. So it means that the cost is greater than the benefit, and therefore the NPV is negative. This minus this is negative, therefore you would reject. Okay, not accept this lockbox proposal, because the cost is higher and the benefit is lower. Is that okay? That's how you solve this kind of problem. Right, this is an example. There are more examples in the book, so you can try that. Okay, next we move on to a topic called cash disbursement. Just now it was cash collection. There are other methods of cash collection. The book discusses that. There's nothing in the slide, but please read the cash collection methods in the book, the textbook. Here in the slides they have just discussed or looked at the logbox system, which is only one method. There are other methods for cash collection. Alright, now cash disbursements. Okay, this is another aspect of cash management. Okay, so the idea here is to slow down payments, so that this can increase the disbursement float. The objective of managing the float is, if it's a collection float, we want to expedite, we want to collect earlier. But if it's a disbursement float, we want to delay this. Why? Because if there is a delay, you have made the payment but the funds would still be available in your bank account. Therefore, disbursement float is good if you can increase the disbursement float for the company. But note this, there is a but here. It may not be ethical or optimal to do so. Optimal here means it's not ethical because you actually do this at a cost of another, usually your supplier. You pay your supplier later by expanding or increasing the disbursement float. Okay, so that it's not ethical and it's not optimal. Sometimes the suppliers would not want to deal with you if you keep doing this, and therefore it's not optimal. So the idea is you try and expand the disbursement float or delay the disbursement float or increase the disbursement float without affecting your relationship with the supplier. Okay, so there are some methods that you can use. So one is called the zero balance account. So how does this work? Okay, in Malaysia too, we have similar arrangements. The banks can arrange something for you, especially for large companies, because these are costly. These services are costly. So first, a zero balance account will have a master account and a set of sub-accounts. Okay, so this master account will be the major account where you earn interest. The sub-accounts are usually accounts to make payments. Okay, when the payments become due. So sub-account balance is maintained at zero or close to zero. Most of the time. And these are non-interest bearing accounts. You don't earn interest in the sub-accounts. Alright, when a payment is made, funds are transferred from the master account to the sub-account. So the sub-account are just to make payments. Alright, by doing that, this reduces the cash safety stock. This is a portfolio effect. We have seen this in chapter 13, the portfolio effect. By combining different stocks in a portfolio, you can reduce the risk of the portfolio. Likewise here, by having a set of different accounts, sub-accounts here, a lot of different accounts. So the idea is not all the accounts will have the same at the same time, a need for payment. Okay, there will be some accounts where you have a positive balance, some will have a negative. Some will be in deficit, some will be in surplus. So one will offset the other. And when you maintain the master account, if there's a positive balance in a sub-account, this can be transferred to the master account. And then there may be another sub-account that has a negative balance or a deficit account. Therefore, the amount from the master account can be transferred to that sub-account. Alright, and therefore this availability of transfer, this flexibility of being able to transfer amount between accounts reduces the amount of safety stock, or cash safety stock, meaning cash that you keep for precautionary purposes, can be reduced. Okay, so that's the main advantage of having this zero balance account. The other is controlled disbursement account. All payments due in the day are informed by the bank in the morning, and funds are transferred by wire, that means electronically. Okay, and the payment is then made. Okay, so this is controlled disbursement. You don't pay before it is due. So companies are very careful when they make the payment. They make the payment only on the due date, not before the due date. If you pay before, then you are losing the funds that you can use for other purposes. Alright, so this is one way of controlling your cash disbursements. Now the other aspect, the last aspect in this chapter is about investing idle cash or surplus cash or excess cash. So this cash is short term. We are talking about working capital management in these few chapters. Therefore, this cash is available only for a short period of time. Therefore, we will invest this in money market instruments. Money market securities. Money market here means instruments that mature in less than 1 year. So these are financial instruments with an original maturity of 1 year or less. That is what we mean by money market instruments. So we have idle cash or excess cash. We invest that in money market instruments. So these are temporary cash surpluses. This is due to seasonal or cyclical activities. So you buy marketable securities with seasonal surpluses. And then you convert these securities back to cash when you have one moment. Right. So the seasonal or cyclical activities. Okay. So you buy marketable securities with seasonal surpluses. When you have extra cash, then you purchase marketable securities. Then when the deficits occur, then you convert the securities back to cash to make the payments, so that you overcome the deficit. That's the idea behind having this cash surplus in form of marketable securities. So you can also have this marketable securities. You can buy up marketable securities for the planned or possible expenditure. You can accumulate funds in the form of marketable securities. Okay, in anticipation, expecting that you make some capital expenditure in the future, rather than keeping it as cash, because cash does not earn you any return. What you can do is you convert the cash to marketable securities, and then marketable securities can earn you some return, some yield, and this can be liquidated when needed to convert this to cash, so that you can make the expenses to make some long-term investments and so on. Right. Now this diagram tells you when you can have this marketable securities. So this is similar to what we have seen in chapter 18. This is the portion of long-term financing. This is the total assets. It varies over time due to seasonal needs. So sometimes you need high amount of assets, sometimes low. Right. So if you have this much of financing, this is the total financing, long-term financing that you have, then when your asset needs go down, at this point, what you can do, this additional financing, you can convert this to marketable securities. And therefore, this light blue area will be marketable securities. So once the need for assets start to increase, then these marketable securities can be converted to cash, so that this can be used to buy the assets that you need. Okay, rather than keeping it as cash, you can convert this to marketable securities. So the actual assets will move this way. From here it goes down here, then it will move up. Or it will go up this way. Rather than going down. This going down here is just an illustration. Because this portion will be marketable securities, and this will be part of the assets. Okay, so that is how this works. Marketable securities are purchased when there is excess cash at this point, and then